And welcome, folks. This is Dave White sitting in for the one, the only Tom O'Brien. I am your guest host, and we'll persevere without the one and the only Tom O'Brien. If you are just getting in your cars today, we had a day that could have been a lot worse. And my guess is that we're going to see this market move down slowly, and we've pretty much had that for the last 50 points down in the S&P cash with a few hiccups, thinking that maybe we're going to go higher. The Dow Jones closed down 46 points at 17,683. When we look at the S&P, it was off 8 points at 2068.76. And in the NASDAQ, we were off 17 points, closed at 14,991, so under that 5,000 mark. We're under most of the century marks for most of these bigger indexes. And when we look at what the volume was, that becomes a much trickier proposition. Let me just make sure I update this to see what we have out here for final volume today, because we get so much of it in the last few minutes. Okay, we came in at 3.4 billion shares on the New York Consolidated Tape. If you listen to this show regularly, you might hear Tom talk about the floor-traded New York Stock Exchange tape. That does not include all the ECNs and Amex and all the other stuff. But if you added the NASDAQ volume and this volume together, it would be the volume of every share of publicly traded stocks out there. So 3.4 billion, is it a whole lot? Yeah, I'm pretty sure that we're going to see something in the range of about 4.2 to 5 billion when we see this market truly crack. At that time also, you may have, that may be an exhaustion move to the downside. You may get to an ABC down from there, but we haven't had the kind of volume either to the upside or to the downside that really shows conviction one side or another in the markets. But we continue to move forward and I think lower. In fact, my call, and it's been this way for a while, is we continue to see on average lower prices until we see the FOMC actually raise rates. At that point, I think the market's going to go, you know, if they can raise rates, they must think that this economy's humming along. In the meantime, we continue to have a few issues before us. Number one is the dollar and the strength of the dollar. We closed pretty much right at the cusp of breaking out much higher. We've got a lot of intervention, at least I believe we have intervention from Treasury, FOMC, Euro, all the other agencies, the three-letter agencies out here. We closed at 76.27 on the dollar index on the continuous contract. That was up 16 cents. We were up a little bit higher than that. I suspect, though, that we see a lot of people wanting to see on the strong, sit on the strong dollar at this level, mostly the governments. My belief is that once we see a sign of strength above 96.30, that we're probably going to rocket on to about 100, which was the last high in the dollar index. Of course, the dollar index, if you're not familiar with it, is a basket of 6 stocks, of which the euro is, what, almost 50%? That's some huge number out there. But I do digress.
That it's all just a little bit of history repeating.
On this day in 1785, Congress declares that the money unit of the United States will be the $1 as the lowest continuous piece. I didn't read anything in there about pennies and nickels and quarters. I just assumed that that's all part of it. And the $10 bill. And, of course, no talk about the Benjamins, as he had not been president yet. So Franklin, Benjamin Franklin, because he was never president. So they couldn't have talked about that as a president. Is he the only non-president? I'll have to think about that for a while. As always, it's all about the Benjamins. But on this day in 1785, we get what is known as the greenback, the dollar, king dollar. Yeah, long time away from then. When we look at markets outside the United States, of course, most of the action was in the Eurozone and in Asia. Of course, what we saw in the Shanghai was a move up almost 7.5%, maybe 8% higher. I can't remember exactly. It sold off rather briskly back down to about 2.5% higher. There was a lot of finagling in those markets. Of course, Nikkei was down 2%. Hang Seng was down 3%. My guess is that we start to see a lot of intervention from China and the U.S. markets and euros. Probably saw some of that today. The one thing that central bankers around the world want is what they call an orderly market. Doesn't matter if it goes to 0 or even minus 10. As long as it takes 5 years to get there and it's an orderly market, they just don't want any kind of panic. They think they can handle everything unless it gets momentum of its own and starts breaking down other features of the financial system. And, of course, that's what everybody is worried about in Greece right now. When we actually look at the EU, I had it right and messed it up. The DAX was down 1.5%. FTSE was down 0.75%. And the CAC, the French 40, was down about 2%. So we continue to see markets that are under pressure. Could we go sideways for a couple of days? I think the answer is yes. Will we see intervention? Almost definitely. And my guess is that they're going to just want to let the air out of this giant balloon slowly as they can. And that is a very difficult thing to do. In fact, I play this clip every once in a while just because it may be one of the most profound things that I've heard anybody say about the markets for a while. And it's L. Arian, the ex-chief over at PIMCO Bond Funds. Of course, he's found a new home himself. But one of the most entertaining and provocative things that I've heard in a while.
So what we need is for markets to consolidate in the middle. Instead, markets go one way or the other. So when we have really good days, that actually makes Fed officials nervous. Right.
Because really good days in the markets, you mean?
Really good days in the markets because it takes prices beyond what's justified by fundamentals. They worry about excessive risk-taking.
Well,
they worry about
down days either.
And they don't like down days either, right? So what we need is a period of consolidation. The trouble is that the markets won't stay in the middle. The markets will either be discouraged by very low rates and go into high risk-taking, or will switch the other way around.
And that's pretty much it. The markets are pretty much bipolar. Either everything is great, getting better, or it's bad, getting worse. It's tough to tell people to just leave your cash in a market that goes nowhere. They'd just rather have that in their mattress. And that continues to be the conundrum, the enigma, wrapped in a riddle. And we will be back in just a minute. You can always call me at 877-927-6648. You can email me at path@tfnn.com, and we'll try to get to your questions. You can always post a message in the den.